I want to tell you something I don't think gets said clearly enough in personal finance content. Protecting your money is just as important as growing it. Anyone can tell you to buy an index fund and hold it for 30 years. That advice is not wrong. But it leaves out an entire conversation. What do you do when the conditions that made that strategy work for the last decade start to change? What do you do when inflation is sticky, geopolitical risk is surging, and the stock market is sitting near all-time highs, while the macro picture underneath it is getting uglier by the month? You start asking different questions, and one of the questions I've been asking and acting on is this: what historically performs well when stocks struggle, inflation persists, and geopolitical chaos is the daily headline? The answer, more consistently than most people want to admit, is energy, specifically oil. And in this video, I'm going to walk you through exactly why I'm personally moving money into oil right now, what the current numbers actually say, the specific way I'm doing it that limits my risk, and what I think happens next. Not to tell you what to do, but to show you the reasoning so you can make your own call. My name is Reid, and I'm a financial educator, and I want to be upfront about something before we go any further. I am not an oil analyst. I am not an energy sector specialist. What I am is someone who studies how regular investors can protect and grow their wealth across different economic environments, not just the easy ones. And the current environment is not an easy one. It is one where I think a lot of people are going to be surprised by how their portfolios hold up over the next 12 to 18 months. If they're sitting entirely in tech-heavy growth positions with no hedge against what's happening in the real economy. So let me show you exactly what I'm looking at and why it changed how I'm allocating money right now. Let's start with where oil actually is right now, because the numbers are striking. As of this week, WTI crude oil, the US benchmark, is sitting around $100 per barrel. Brent crude, the international benchmark, is above 110. Those are not normal peacetime prices, but we are not in a normal peacetime environment. Oil is currently 75% higher than it was a year ago, not 10%, not 20%, 75%. The primary driver is a conflict with Iran that began in late February 2026 and has effectively disrupted the Strait of Hormuz, the narrow waterway through which roughly 20% of all global oil flows every single day. When that channel gets disrupted, the entire global oil supply chain gets disrupted. There is no quick workaround. There is no switch you flip to reroute 20% of world energy supply in a matter of weeks. U.S. crude exports have surged to record levels as buyers around the world scramble to replace Middle Eastern supply. Saudi oil infrastructure has taken hits that reduced production capacity by around 600,000 barrels per day. And Goldman Sachs, one of the most watched voices in commodity markets, just raised its oil price forecast and is now warning that Brent crude could average above $100 per barrel through 2026 if the Strait of Hormuz remains restricted. Now here's the thing that matters for your portfolio. When oil prices stay elevated, a specific and predictable set of things happens to the rest of the market. Transportation costs rise, manufacturing input costs rise, consumer prices stay high, inflation stays sticky. The Federal Reserve stays trapped between wanting to cut rates and not being able to because inflation won't come down. And growth stocks, particularly tech, face compression because elevated rates reduce the present value of future earnings. In other words, high oil is not just a gas pump problem. It is a portfolio problem for anyone who is primarily positioned in the parts of the market most sensitive to interest rates and inflation. And yet, while most of the market struggles in that environment, one sector historically thrives: energy. Let me explain exactly why energy outperforms in this specific environment, because understanding the mechanism is what separates a reasonable allocation decision from just chasing a price that's already moved. Energy stocks, oil companies specifically, make more money when oil prices are higher. That sounds obvious, but the scale of it is what's important. ExxonMobil and Chevron just reported first quarter earnings. Both companies beat Wall Street's expectations. Chevron earned $1.41 per share on an adjusted basis against estimates of 95 cents. Both companies raised their dividends by 4% while posting those results. Diamondback Energy, a pure-play U.S. oil producer, is up 33% so far in 2026. That's in a year where the broader S&P 500 is grinding near record highs with increasing volatility underneath the surface. But here's the thing about oil investing that most people don't think about. There are three completely different ways to be exposed to oil, and they carry completely different risk profiles. The first is upstream, companies that drill and produce crude oil. These have the most direct leverage to the oil price. When oil goes up, their revenues go up proportionally. The risk is that when oil falls, revenues fall just as fast. High reward, high volatility. The second is midstream, the pipeline and infrastructure companies that physically move oil from where it's produced to where it's refined and sold. These companies charge fees based on volume, not price. They largely don't care whether oil is $60 or $110. They care that oil is moving through their pipes. Enterprise Products Partners is currently yielding 5.6% annually. Energy Transfer is yielding 6.7%. These are cash distributions paid out regularly, more like a bond with infrastructure backing than a typical stock. The third is integrated majors, companies like ExxonMobil and Chevron that operate across the entire value chain. They produce, refine, and sell. This gives them natural hedging across the cycle. When crude prices are high, upstream profits. When crude prices fall, downstream refining margins often improve because input costs drop. They are slower and more diversified, less explosive upside, but more stability across the full cycle. Now here's the specific reason I'm paying attention to the midstream in particular. In an environment where I'm not sure exactly where oil prices go from here, whether they stay at $100, climb toward $120, or pull back toward $80 as a ceasefire develops. The midstream doesn't require me to be right about the price direction. I just need oil to keep moving through infrastructure. And it will, at any price level, because the world runs on energy. Enterprise Products Partners has raised its distribution for 27 consecutive years. That includes 2008. That includes COVID. That kind of consistency at a 5.6% annual yield in an environment where inflation is still elevated and savings accounts are losing purchasing power starts to look very different from how it looked when rates were near zero. This is the kind of investment that doesn't require a prediction. It just requires an understanding of the environment. Let me walk through how I'm thinking about this practically, and how you can apply the same framework regardless of how much or how little you're working with. Step 1. Understand what role this plays in your portfolio before you buy anything. Oil is not a replacement for your core index fund positions. It is not a get-rich-quick play on a price spike. It is a hedge, a position that is designed to perform well in the specific economic conditions that are most likely to hurt the rest of your portfolio. If you are 100% in S&P 500 index funds, a sustained period of high inflation and rising energy costs will likely pressure your returns. An energy allocation that moves in the opposite direction of your growth positions provides balance. That is the purpose of this move. Not to predict oil prices perfectly, but to reduce the scenario where all your positions struggle at the same time. Step 2. Decide which part of the energy sector matches your risk tolerance. If you want maximum exposure to the oil price and you can handle volatility, upstream producers give you direct leverage to crude prices. These positions will move sharply in both directions. If you want income and stability without needing to call the oil price correctly, midstream companies offer dividend yields in the 5 to 7% range, with business models that are largely insulated from the commodity price itself. These are slower, but more predictable. If you want a middle path, integrated majors like ExxonMobil and Chevron give you diversified energy exposure, strong balance sheets, growing dividends, and less single-point price risk than a pure upstream play. I personally am currently split between midstream income positions for the yield and stability, and a small allocation to an integrated major for broader energy exposure. I am not making a large concentrated bet that oil hits $130. I am making a measured allocation that benefits from the current environment while limiting my downside if conditions shift quickly. Step 3. Size it appropriately. I want to be very clear about this. An energy allocation is not something you put your entire portfolio into. Depending on your situation, a 5 to 15% allocation to energy as a hedge makes sense to me, enough to meaningfully benefit if the thesis plays out, not so much that it damages your long-term position if oil reverses sharply. Commodities and commodity stocks are volatile. A 30 to 40% drop in oil prices is entirely possible if a ceasefire fully materializes and the Strait of Hormuz reopens. You need to size this position knowing that scenario could happen and being comfortable with the outcome if it does. Step 4. Know your exit condition before you enter. This is the step most people skip, and it's the one that most determines the outcome. Decide now, before you buy, under what conditions you would sell. Is it a price target? A change in the geopolitical situation? A specific amount of loss you're willing to absorb? The worst outcome in any investment is selling in a panic because you didn't define your exit before emotion got involved. If oil pulls back to $70 because a peace deal materializes and you hadn't prepared for that possibility, you will likely sell at the worst time and realize a loss that would have recovered. Know what you're in it for. Define the exit, then execute with discipline regardless of the daily noise. Step 5. Keep watching the Strait of Hormuz situation. This is the single most important variable in the near-term oil price story. If the strait fully reopens and Iranian oil flows resume, prices will fall. If the conflict escalates or the blockade extends, prices stay elevated or climb further. Goldman Sachs is saying above $100 per barrel if the closure persists. That is not a small number for energy company revenues. I check the geopolitical news on this once a week, not daily. Daily checking leads to daily overreaction. Weekly check-ins give you the information you need without the noise that leads to bad decisions. Here's what I want to leave you with. I'm not moving money into oil because I think I figured out exactly where energy prices are going. Nobody has. What I'm doing is recognizing that the current environment, persistent inflation, a Fed with no clean options, a geopolitical conflict disrupting global energy supply, and a stock market near all-time highs that is increasingly sensitive to rate movements, is exactly the kind of environment where having zero energy exposure is a risk in itself. When everything in your portfolio is correlated to the same conditions, low inflation, falling rates, tech dominance, you don't actually have a diversified portfolio. You have the same bet made in slightly different ways, and if those conditions shift, everything moves together. Oil and energy broadly has historically been one of the most reliable portfolio hedges against inflation and geopolitical disruption. That doesn't mean it always works. It doesn't mean it's without risk. It means that in the current specific environment, it makes sense to have some exposure, sized correctly, entered with a defined exit, and held with the same discipline you'd apply to any long-term allocation. The people who build real wealth across different economic cycles are the ones who don't just ride one horse. They position for the environment in front of them, not the one that's already behind them. That's the thinking behind this move. Take it, apply your own judgment, and make the decision that's right for your specific situation. I'm Reid. I'm rooting for you, and I'll see you in the next one.